The annual gathering of global central bankers kicks off this week in Jackson Hole. Investors are waiting to hear from Federal Reserve Chair Jerome Powell. He'll give his remarks on Friday. What can we expect? Well, joining us on today's Market Insight is Mabrouk Chetouane, Head of Global Market Strategy at Natixis Investment Managers. I'm your host, Leah Mishkin. Mabrouk, first of all, thank you for being on the show. Let's talk Jackson Hole. We have Powell's speech on Friday. Traders have fully priced in a 25 basis point rate cut in September, with a 29% chance of a 50 basis point move. One currency strategist told Reuters the speech is an opportunity for the Fed chair to either endorse or push back market pricing. Do you agree?
Well, thank you very much for this invitation. First of all, we need to remind that this Jackson Hole Symposium is an occasion for all the central bankers to anchor expectations. And I think this is the key things that we need to bear in mind when it comes to central bank expectations. I mean, the market, they have already priced, a 25 basis point rate cut. But the key question is, what is the next move? What could be the next move? And you just said that there is a possibly a likely 50 basis point priced in by the market. But I think this is not the most likely scenario for September. The Fed has to control market expectations. We all know that it can go very fast. And the key priority for the Fed is to stabilize, to anchor expectations. And this is why I think the speech, the statement of Jay Powell will be crucial for the markets for the rest of the year. And we do expect, in my opinion, the Fed to deliver only two rate cuts for this year because the recent data that we had they are not signaling that the US economy is in a, let's say, recession mode. It's very difficult, to make any clear conclusions on the US business cycle. When we look at the data, they are very strong. They're extremely, supportive. And for the Fed, it is a key challenge for to anchor these expectations.
And the dollar retreated broadly today. Could the Fed's decision on interest rates pave the way for a weaker dollar moving forward?
As you said, the decision made by the Fed, proposed by the Fed, is already priced in. And I think what is extremely important to keep in mind when it comes to the USD is the next move, the expectations. And when we look at the depreciation of the USD against, the GBP or the euro, what we can say is the market is pretty confident on the fact to deliver additional rate cuts. And this is, I think, what we need to bear in mind when it comes to the FX parity between the USD and the euro and the GBP. The market is expecting additional rate cuts, and this is why we have this slight depreciation of the US dollar against the major currencies.
Right, and the dollar was about 1% lower against the yen at last check. One senior economist told Reuters he expects the Bank of Japan governor to hike rates in Japan, assuming the base case continues to hold. Do you agree?
Well, there are two stories when it comes to Japan. On the one hand, we have seen this episode at the beginning of August, the 5th of August, of an increase of the volatility triggered by what happened on the FX market and especially in Japan. So, and I think the BOJ is not ready, to make any move if the financial condition has not returned to something, let's say, normal, actually. So, in my opinion, if we don't have, a normalization of this financial stress, which is actually the case, there is no reason to see the BOJ moving in the near term. However, when it comes to the macroeconomic situation in Japan, when you look at the salary increases, clearly there are pressures for the BOJ to deliver an additional rate hike this time around. Simply because when you look at the historical data, increase in wages, they have reached, a 30%, a 30-year level high in Japan. We are close to 4.5% increase in wages expected for this second half of the year, which is, quite significant to be ignored by the BOJ. The BOJ will maintain, will keep, a certain pressure on the interest rates just to signal they are ready, to hike if necessary, and it is translated in the FX market.
Right, and here in the UK, we're starting to see movement in the housing market after the Bank of England's decision to begin cutting interest rates from that 16-year high. According to the property website Rightmove, buyer inquiries in August were 19% higher than a year earlier. Financial markets have priced in one, possibly two further cuts this year. What do you expect the BOE's rate easing path will be?
Well, the BOE is not in a very easy situation like the Fed, for example. I mean, the decision made at the beginning of August was a good move, definitely, because it sent a signal to the market and to the economy that the BOE is pragmatic and they are ready, I mean, to deliver if necessary. But when we look at the recent data that we had for the UK economy, they are pretty good. Clearly, the PMI indices on the manufacturing side and on the service side are increasing, and when you look at the data on the real estate sector, they are also, I mean, signaling that there is some improvement in this sector. However, when you look at demand for credit, I mean, clearly it is still, I mean, lagging and suffering from, I mean, these high level of interest rates. And I think this is why I think the BOE has decided to lower the interest rates to accompany in the economy, to accompany the business cycle, and to smooth transition toward, I mean, let's say, a more normal growth, a more supportive growth for the UK economy. So, one additional red card for this year is, I mean, corresponds to a kind of an ease of the monetary conditions. It will not. It doesn't mean that the BOE is, I mean, will continue in the linear mode to lower their interest rates, but definitely an additional cut, yes, for the BOE is more than likely before the end of the year.
All right, Mabrouk Chetouane, Head of Global Market Strategy at Natixis Investment Managers. Many thanks. You can stay updated on these headlines and more on Reuters.com. That's Market Insight.